do think the pandemic shock is a negative shock to the inflation dynamic, which on this graph you might think of it as kind of from point A to point B. So if you like, that's the initial, there's a drop down in the projected inflation, and we did mark down projected inflation in our projection rounds this year. Now, at that point, this graph is supposed to capture the choices we face. One choice is the yellow line, which is point B to point E, which is basically saying, look, we're at a lower point. It's going to take longer to get to the inflation aim, and let's just move gradually from now. So that yellow line is one possible path. However, I think that's costly because, of course, lower inflation and lower expected inflation, it raises the real interest rate. It's not good for the recovery, and it's also risky in terms of the risk that it might lead to downwards in inflation expectations. So, if you like, it's probably wiser and safer to go more towards the upper zone. So, for example, another pathway is point B to point C, to have a phase of boosting inflation to get back to the trajectory we were expecting beforehand, or at the very least somewhere in that zone closer to that border rather than the other border. And that's essentially the motivation for the design of STEP. It's to create a kind of intense phase of asset purchasing to build the momentum in the inflation dynamic in order to allow us to be closer to that zone. And so if you like, this a two-stage approach we have. One is to restore the momentum in inflation closer to that zone. And then after the pandemic is over, we return in the second stage to essentially the campaign to bring inflation towards our medium-term inflation aim. And that's essentially going to be our policy task. And as always, the Governing Council stands ready to adjust all of its instruments as appropriate.